Well, good morning and welcome to the Plato Australian Income Webinar on what is the outlook for income in 2019. My name is Mark Cormack from Pinnacle Investment, and Pinnacle are equity partners and work alongside Plato to distribute the Plato Australian and Global Income Funds to the Australian financial advisory marketplace. And today I'm joined by one of Australia's leading experts in the area of equity income investing, Plato's Managing Director, Dr. Don Hamson. For our webinar today, we're going to provide an update on the outlook for income, why tailoring an investment approach specifically for low-tax investors can enhance retirement income, and provide you with an update on the ALP Franking Credit Proposal policy. As a bit of background, Plato has a unique approach to managing money. Plato is one of the very few fund managers who fully assess the after-tax implications of their investments, and this has resulted in the Plato team developing a high-yield Australian and global equity income solutions specifically for low-tax investors such as retirees. Just to explain this further, because CGT has no impediment for low-tax investors, Plato actively rotates through dividends to deliver high-income solutions. This has resulted and seen a 12% income return over the past 12 months for the Plato Australian Shares Income Fund. And it's also important to note that Plato have outperformed the Australian Equity Index by 2.7% from a total return basis. So we're not sacrificing total return in terms of delivering a high income solution. Before we kick off today's webinar, just a couple of quick housekeeping items. Today's Plato presentation should last around 15 to 20 minutes, and that'll be followed by a Q&A. All attendees have the opportunity to ask questions via this Q&A by clicking the Questions tab on your screen. So without further ado, I'm going to hand you over to Plato's Managing Director, Dr. Don Hamson, for today's presentation. Thanks, Don.
Thank you, Mark, and good morning, listeners. So let's just start with a bit of a recap of 2018. Turned out to be a challenging year, particularly the last quarter. Market fell 8% in the last quarter of last year on the back of a number of issues, worries about rising interest rates, reductions in global liquidity, that would basically meant that instead of having a quantitative easing environment where central banks are buying bonds and raising their prices and lowering yields at the long end of the curve, they've been now starting to sell bonds or stop buying in some cases, but in the US case actually quantitative tightening by selling bonds, and interest rates were rising. We saw slowing economic activity around the world. The leading indicators are of that, and of course here in Australia we saw falling house prices in Sydney and Melbourne in particular, and the continuation of a trade war, tit for tat, between the US and China. They were all the major drivers of the falling markets in the fourth quarter. The silver lining, of course, out of that negativity is that the first concern, which is rising interest rates, has actually now dissipated. It's really gone away because people have so worried about it that markets have fallen, activity is slowing, so the tightening has already succeeded. And pretty much, and we'll show you a chart, around the world, markets are now suggesting that interest rates are going nowhere, and there's even talk here in Australia that the next move might be down, not up. So that's the silver lining about the troubles. And in fact, given that is what happened over the quarter, I think it's why we've had a positive start to 2019, as people say, well, actually, we don't have to worry about rising rates in the US. It looks like the Fed is on hold because there's been a number of dovish comments from some of the Fed members over there. For Plato, the Plato Australian Shares Income Fund, interestingly enough, it was one of our best years in terms of alpha. We had a very strong active return. We'll talk a little bit about that later. Albeit total returns were tough, but active returns were strong. But we also actually achieved a record year, biggest ever by a long shot, in terms of the income we generated and distributed from the fund. That we're talking 12% versus, I don't believe we've had a year that's even got into double digits. Best years previously were 9 point something. So to generate 12% income is remarkable. Of course, it was boosted by a couple of one-offs. We don't expect them all the time, but we do expect potentially more of these this financial year, which with a big off-market buybacks by Rio and BHP, and there may be others from other companies later in the year. and our stock selection was very strong in the financials and consumer staples, and that meant by being in the right side of on the right side of the stocks that underperformed, as well as being on the right side of the stocks that outperformed, and we'll talk about those a little more. Now, if we move to the outlook for income for this year, because interest rates aren't going up, then again, it is pretty tough for traditional asset classes such as term deposits and bonds. We've actually seen 10-year bond yields in Australia and the US come down in particularly the last quarter. Term deposit rates is sort of just over the 2%. Maybe you can get 2.5% or 2.6% if you shop around. Misky world, because markets fell, I mean, the flip side of markets falling is that yields go up. So at the start of last year, we actually had a forecast for the Misky world dividend income of actually just under 2%. Now we've got a forecast which is a bit over 2% for this calendar 2019. AREIT's 5%, and Australian shares, including franking, were just a touch under 6% last year, but they, so the flip side of falling share prices is that the yield goes up a little. Put those sum of low yields into perspective. We've done this chart for some time, which is the interest you get on $1 million. And we just had the inflation rates coming out yesterday, 1.8% for the inflation for 2018. So if you look at the real earnings on term deposits or on 10-year bonds in Australia, if you take away 1.8% interest rates, you are lucky to get $5,000 or $10,000 worth of income out of those asset classes after allowing for inflation, which is not much if you're, getting like $25,000 pre-inflation, $5,000 to $7,000 or $8,000 post-inflation. That's not going to fund much of a retirement. And in terms of the outlook for interest rates, we've been running this chart for a while. This chart has changed dramatically in the last 3 months. What has happened has changed a lot from this time last year. Last year, markets were expecting US interest rates to move to 2.5% and even higher. And the Fed did tighten in December, and it has moved basically their interest rates in the US to 2.5%. But the yield curve expectations, which is the top red line there for the US, is that interest rates will be flat for the foreseeable future. The next line, which is the only other one that's probably really meaningful or most meaningful for Australian investors, is the Australian curve. We actually get this off the bank bill curve. So first thing to note, the green curve is pretty flat. In fact, there's a potential for it to dip over the next 5 years, but it's actually above where current cash rates are. And that reflects the fact that bank bills and the wholesale funding for banks is already above the cash rate. So there has been a sort of a market tightening because, and you hear it's one reason why the NAB and the other big four banks last year raised their interest rates a bit, because their cost of wholesale funding, if they go and issue bank bills, they're already paying more than 1.5%, they're paying close to 2%. But if you factor that back out, the market's saying that official cash rates are looking like they're going to be flat for the foreseeable future, and there is certainly talk that the next rate move in Australia may actually be a cut at the towards the end of this year, particularly if activity slows, which we think it will. The GDP growth will probably slow a little. We're not expecting a recession, but we are expecting a slowdown in a softening in economic outlook. And if property prices keep falling, then that may be enough to make the RBA move. Now, moving on to our fund, as fund tailored for retirees. Just to refresh that this fund is an income fund, so it has an income objective to create more income in the market, and also has a total return objective to outperform. And interestingly, this is not a fund that is massively overweight banks, and that's not how it generates its extra income. It does so by actively trading through the portfolio. So we don't have these big sector biases, which clearly, with the Royal Commission coming out, findings coming out on Monday, not tomorrow, but on Monday, we'll get to see what's going to happen, but who knows, and hopefully it'll be a good result rather than a draconian result. Which would be our expectation will be, because the interim findings were that, we have the laws in place, they just need to be policed by the authorities correctly. Moving to performance, said it was a good year for us. So these are after fees. Whilst the absolute performance wasn't great, we did have a positive return for last year, which was certainly better than the benchmark, which actually fell even when you include franking. These are returns including franking after fees. We outperformed the benchmark by 2.7%, so if you add 90 basis points in fees, we actually had a pretty strong year in active return. And particularly we performed strongly in the last quarter, which I think clients do outperformance in down markets is something that is worthwhile. Looking into some of the details of where we added, I also mentioned it was a record year for income. We had about 12% income. It's the usual suspects in terms of stocks that contributed income, the big four banks, we rotated through those. Big contributions from the miners, BHP and Rio, but also the off-market buybacks. They were a massive contribution because there were some very large buybacks late in the year from Rio and BHP. And they're one-off, they're exceptional, but funds that are managing for retirees should take advantage of these. And not only did it add 5.5% of gross income as franked dividends, because when you do a buyback, you basically receive payment largely in the form of franked dividends, but they're also quite valuable for the clients after tax. They added alpha as well as adding income. So all around a strong year for income, and so by way above our normal expectation of around 9% income. We actually distributed after fees 12% income last year. In terms of active performance, so this is the difference. The income is the first objective, and but of equal sense is how do we make money and how do we beat the market. Again, we had very strong contributions from the likes of BHP. It was a strong performer for the year. Woolworths, AMP, a strong contributor because for most of the year, other than maybe the first month or two of 2018, we didn't own AMP, and clearly we know there are challenges there. So we don't need to elaborate on those, but you can, if you avoid the landmines, you can actually save money, a lot of money for your clients. We're also underweight Lendlease and Origin Energy, but also good weightings and good timing in the likes of CommBank and Westpac, and solid contributions from like South32 being there at the right time and Qantas. So a range of stocks, but this is a well-diversified portfolio. We do track the index fairly closely, but we had a good solid value. And there you can see on this slide you can see the realised yield after including franking, with the franking being the light blue contribution at the top, and the fund and the cash yield. The actual cash yield last year, so this is interesting, just the cash distributions, even without franking, was over 8%. It was almost our normal contribution from franking credits and cash. 8.7% is very healthy. So a very strong year, say with some strong contributions from those buybacks. But we still see, in fact, strangely enough, we are forecasting that the financial year number, because all this extra income was generated in the December half, we think the first half of this year, so this calendar year 2019, so if you look at the financial year 2018-19, I think that financial year will be our strongest, even stronger than calendar 2018. I'm looking at probably more like 14% gross income for the financial year. And one reason is because BHP has already paid a massive special dividend, so and we can talk about that in a minute. Because we do, buybacks are included in that. So the story of 2018 was it was actually a strong dividend year, even though you might have, your first thoughts might be, Telstra cut its dividend by 30%, and the banks largely had flat dividends, a very tiny increase by CBA. But the overall market, and this is including buybacks, this is just normal dividends, the market increased its dividends by 8%, despite the fact that we had a 30% cut by Telstra and 8%, and flat bank contribution. Very strong contributions from the materials sector, both the iron ore producers, South32, and the energy stocks started repaying. Some of them had stopped dividends, they started repaying. But pretty much across the board, apart from telecoms, it was a strong year. As I mentioned, BHP's already paid a massive special. It actually was paid this week, $1.41 special dividend fully franked. It paid in calendar 2018 a normal dividend of $1.59. So you've almost got an extra full year's dividend in that special. Remember, that's on top of the buyback that they did, so this is separate to the buyback. So BHP are finally returning capital and releasing franking credits to their investors. The reason they're able to do it is because they've sold assets, so they are able to actually start to dig into that massive franking account balance that they have. They actually have plenty more capacity to pay more dividends. They just need the cash. Interestingly enough, it was actually, while Australia increased dividends by 8%, the rest of the world did even better. And Daniel Pennell will be providing a global dividend webinar in 2 weeks' time on February the 11th. And he'll talk about how the rest of the world actually increased dividends by over 12% in calendar 2018. So actually Australia, with only an 8% increase, was a bit of a laggard there. But our fund, because we actively move and participate in buybacks, we had a much better than the 8% increase. And on that buyback, just to show you why we do them and how beneficial they can be. So BHP did a fairly large buyback. It was worth about 21-22% for clients, for pensioners, or for tax-free investors. It was a huge buyback, 7.3 billion, 8.3% of shares on issue, and because it was so large, it wasn't scaled back as much as previous buybacks, and so not only was it a very big buyback, but we got a fair bit of it, and that's worth a significant amount of money for our clients. And when you add up the value of the franking credit, the cash dividend, and the small capital component, it was significantly higher than the market price, what you could sell BHP in the market, and that's why we do them. They're very tax effective at the moment for retirees and for zero tax investors. But it was actually, so that 21 or 22% is sort of rounding between one or the other, is for zero tax investors who can fully use franking credits. Obviously there are some concerns about whether that will continue, but it was still reasonably valuable for just a 15% superannuation fund, so you still make quite a bit of money on it, but not as much, but you were still better off after tax. So on that line, just on the franking credits, not sure if people are aware, but obviously I think most people are aware of the proposal ALP are putting forward, but there's currently a standing committee on economics going on, inquiry into the implications of removing franking credits refunds. It's getting a lot of press. Today, for instance, there are 7 separate articles in mainstream papers, the Financial Review, the Australian, Sydney Morning Herald / The Age on these franking credit issues, all generated largely out of this inquiry. There's been more than 1,000 submissions, of which Plato, we provided a very detailed submission. But I'd also like to update people, and Plato has been asked to present to this inquiry, and we will be presenting to the MPs next Friday, February the 8th, at the Bondi Junction RSL. And I would say that if anyone's in Sydney and interested, they can attend, but there are also hearings next week in Merimbula on February 4 and Chatswood on February 8th. There are actually a couple of hearings going on today, but you've probably missed the morning one, and there's another one later this afternoon up in Queensland. So we encourage clients and even your clients to attend these, to get the message across to the politicians that this is a big thing for investors. I won't go into it more, but for affected retirees, it can actually reduce your income by up to 30%. So that's a massive impact, and you can see why a lot of clients are upset, because that has a huge impact on people's lifestyle. Just finishing up on outlook, interest rates to remain low, in fact may even go lower here in Australia, and so that's the big change in the last 3 or 4 months, is when instead of a sort of continuing rate increasing cycle, particularly in the US, markets are now expecting that potentially the Fed's on pause, because the economy is slowing, markets have fallen, they tend to precede that. We think there might be an economic slowdown and probably a mid-cycle recession or late cycle, slowdown in the US and a slowdown here. Dividends, on the other hand, we still think will be pretty strong. Because of that ALP issue, a number of companies and a number of LICs have already come out and are looking to flush out as franking where they can. So we actually expect quite a few more dividends, and there's potential for stocks like Woolworths, which if it sells its petrol business, it may do either a special dividend or a tax-effective buyback, and other stocks have excess franking may, if they have the cash, be able to return them. So it could be a truly bumper year, financial year for dividends and franking credits this year. So we expect to be able to continue to deliver strong dividends. Even if there are, the Royal Commission findings are worse than expected, we still think most of the banks will probably maintain their dividends. But there is a fair bit of political risk here. We obviously have an election has to be called later this year, and the ALP are putting up a number of new tax changes which are quite negative for investors. The franking changes are just one. They're increasing CGT rates, or hoping to. They want to stop negative gearing for new investments, and obviously we still have Mr. Trump in Washington, still tweeting off on various things. So hopefully we can get a solution to the tariff war, but I'm not sure how hopeful it can be. But anyway, that is all I had prepared, but I'm happy to take some questions if there are any.
Excellent. Look, Don, always fascinating to hear your views in the world of income investing for low-tax investors, especially considering the outlook for interest rates is looking more benign, and potentially a move down might be in the wings going forward. Look, Don, we have had a couple of questions come in, so why don't we kick off with those? Don, Plato's view on Telstra, has it changed? Last year it was in that dividend trap space.
Look, we still see the risk that Telstra, and it's basically signalled itself to the market, because it cut its dividends 30% last year, but its normal dividend was actually cut 50%. So last year Telstra paid about half the normal dividend it paid the previous year. But it paid the other 20%, if you like. They did pay a 20% special dividend last year, but a special dividend, is special. Why do they call it special? Because it's unusual and you don't expect to pay it every year. So the company itself is sort of flagging that special may not be paid. Now, I'm not sure whether it's going to be this year or next year, but I think there's a very strong chance that in the near term they will drop part or all of that special dividend, and there'll be a further cut there.
Okay. Don, we always get a couple of questions on the banks and financials. Do you think banks and insurance companies may need to reconsider their capital position in light of any franking changes that could have impacts that could have on income securities?
Well, clearly, and I should state this, the ALP proposal is a proposal. They need to win the election, which looks like pretty likely. But I'm still of the view that they're going to have a tough time to get this franking credit issue through Senate. So it's not a lay down misère that that's going to happen. So I wouldn't be too concerned, but let's say the worst case scenario is that it might happen. We actually have seen a couple of hybrid issues after the proposal, and they have gotten away. So, and here's the thing to remember is, yes, there are certain investors, such as people in a self-managed super fund or self-funded retirees. Some of them may lose the franking or not get the refund. But most investors will still be able to use the franking to offset tax payable. So it is still valuable for many investors.
Okay, Don. Another question relating to the franking issue and the ALP proposal. Could you see SMSF's increase exposure to property if franking comes into fruition? I know we've also got the capital gains tax on property as well. So,
well. Perhaps you might say property is looking a bit cheaper, but it's still not necessarily. I don't think Australian property is all that cheap. So, yeah, from a short-term timing perspective, I don't think it's the right time to be now racing out and buying property. But we could see that, but I think that they may, but also look to other asset classes such as global shares and those sorts of things. But again, I think we shouldn't preempt this, because I think there's a reasonable chance that we might, that the current proposal of the ALP will never get its way through the Senate.
Don, you mentioned companies could do more tax-effective buybacks, but pay special dividends like Rio, BHP. You mentioned Woolworths. Do you see any other companies looking to rush in before a certain time this year?
Well, the certain time this year, and we don't know, there's still a big if about whether this franking thing ever gets in, but if the worst case scenario was the ALP got in, they said their intention is to have it starting by 1 July this year, which would be the next financial year. So if companies are thinking, and we are actually encouraging companies to do this, are thinking to flush out franking credits whilst all investors can use them, then they should do so by paying them and actually paying the cash dividend before 30th of June this year. And we've already seen a number of LICs flag special dividends. Mirrabooka, I think, was the first off the cab off the rank, and there's a couple others, and I expect many more to do so. And I'd also hope that some of the companies, such as Rio, BHP, Woolworths, Harvey Norman, Caltex, that have very large franking account balances, Woodside's in that boat as well. Hopefully the planets may align, but companies do need to have the cash to be able to pay these out. Although if there are companies that are under-geared, that basically have lazy balance sheets, some companies might decide to borrow some money to be able to pay a fully franked dividend. So we'd certainly be encouraging them, but we can't force them.
Don, a question on the liquidity of the funds in current environment and in a more stressed environment?
Yeah, well, liquidity of our fund it's very liquid. We answer the sort of questions from the researchers and number of groups regularly on this front. It is a fairly large fund, but it's a large cap fund. Fund's now $1.4 billion, but it's very well diversified. We own over 100 shares, so we have good diversification. So we don't have highly concentrated positions in illiquid stocks. So the fund is very, very liquid, and there's never been any issues on that front.
Excellent. Look, I think that's all we've got time for today. If you do have any other questions, please don't hesitate to contact the Pinnacle distribution team. We will be making this webinar available on the Plato investment website later today. That's www.plato.com.au. We'd certainly like to thank everyone for their participation today. If you have any further inquiries, please refer to the Plato website or contact the Pinnacle distribution team. We look forward to catching up with you on our next webinar, luncheon, or in your office for one of our meetings. So thank you very much and have a nice day.